No, I think, as you said, this is an important budget. It's really the first full budget of the new term. And I think, to my mind, the fiscal deficit is really what we need to see the paths of consolidation continue. Of course, there are growth imperatives as well, but I think in the volatile global macro environment that we have, it is important that India continues to demonstrate its strong macro fundamentals. And it will be important that the government continues on the path that it had indicated last time, that in FY26, the fiscal deficit will drop below 4.5%. So I think that is the first part, and I think it is important also because this is needed to ensure that the cost of capital for the private sector continues to come down. So to my mind, that is the most important indicator. I know there are a lot of expectations around potential tax incentives to boost consumption. But to my mind, more than taxation changes, the focus has to be on improving non-tax revenues. And I think even your previous panel spoke about it, that how do we get the non-tax revenues up? Over the past few years, we have seen tax to GDP improve significantly. But non-tax revenues have not gone up. So I think if we can get some impetus on that, that will actually enable the government really to up spending and support growth.
Ashish, what's the best way to do that? Good morning, Neeraj here. What's the best way to do that, non-tax receipts? Because, I mean, the needs for funds are enormous. The ways to get them, very, very limited, right?
Sure. So I think divestments are really the only way, and it also need not be strategic divestment. It not just be letting go of control. Over the past few years, we have seen, given the improved profitability of many public sector enterprises, improved governance in many enterprises, there have been significant re-rating of these companies. Their valuations are in many sectors comparable to their private sector peers. So the government diluting their shareholding in these companies is something that is certainly possible. In fact, the government can actually also potentially look to go below 51% in many of the companies. But even if they continue to hold majority, there is still a significant room to raise resources, at least this year. But if that path has to be continued, I think then the government also has to think about in which corporations can they operate with below 51% shareholding.
Ashish, in your view, what would be the couple of big disappointments if they were to come, both from a market's perspective and even from an economy perspective?
I think, to my mind, first of all, I think the biggest thing I'm watching out is fiscal deficit. So if there is any kind of dilution in the paths of fiscal consolidation, that will be a disappointment. I know there are growth imperatives, but as I said, given how the global macro is set up, we don't want to give that signal. The second to my mind will be if there is any further changes in the tax structures, particularly direct tax structures, that because already in the last couple of years there have been significant changes. So I think too much tinkering around doesn't really help. You need the new tax regime to stabilize rather than make very frequent changes.
Okay. Ashish, just a word on what has been the big talking point, right? That fisc deficit number, which at 4.9 is a given. Now, assuming that the receipt picture is yes, not looking all that great, but the capex done or the expenditures done have also kind of lagged this time.
Yes.
If the fisc deficit number for the current year is at 4.8 and she sticks to the glide path or improves upon it, normally it would be a positive. But in this case, would the markets be disappointed with it? Because that would mean that the government is steadfastly on the fiscal consolidation path at the expense of spending on economy, because currently the economy needs some bit of boost to revive demand. So would a aggressive fisc consolidation be looked upon as a negative as opposed to a positive, or not so?
Sure. So I think if the fisc consolidation is much more aggressive than the 4.4, 4.5% that has been indicated, yes, I think that will also be seen as potentially a negative signal from a growth perspective, because we know actually it is government spend that has been a key driver for growth for the last 4-5 years, including on the investment side. And given the fact that you have, so actually, as you rightly said, FY25, 4.8, 4.9% is very easily achievable, right? So I don't think there are going to be too many surprises there. And whether FY25 ends at 4.8 or 4.9, it does not really matter from a growth perspective, because that is already in the past. So it is really what is the FY26 government expenditure that is going to come through? Is it going to grow in double digits or not? That is the key that we have to watch out for.
Okay. Ashish, in terms of what budget can do from a capital markets perspective, we've been speaking about economy, we've been speaking about consumption, but purely from a capital markets perspective today, what would you say is the top factor that will give some relief?
So, frankly, some of the challenges that the government has this time around. So, in the past couple of years, the government has had very good tax buoyancy. So, if you see every year, tax revenues have grown faster than the GDP growth, and that has enabled the government to really up the capex spend and overall expenditure. I don't think the market is expecting that flexibility to be available this year. So in that sense, the expectations from the budgets are not very high. Capex growth, we still expect to be in double digit, but as Neeraj highlighted earlier, it is coming on back of the fact that FY25 capex spend probably will be lower than what was budgeted. Right? So from revised estimates, you will have a double-digit growth, but if you potentially look budget estimate to budget estimate, you might not have a double-digit growth. While there has been ask for some boost to consumption, some measures to boost consumption coming from the budget, but I don't think markets have really kind of priced in that, or so if you see the market behavior, price actions over the past few weeks, it is not as if market is going into the budget with some very high expectation. So I think as long as there's no big disappointment in the budget, we don't think there should be too much negativity, even if there's no fresh big bang measure to boost consumption.
Thank you so much, Ashish. Ashish Gupta there from Axis AMC on what is expected from the budget, and hope you have a great rest of the day. We're waiting and watching. Just about 45 minutes ought to go for the budget speech to start. But meanwhile, quick look at the markets and what's buzzing at this point. Mahima is joining us with a list of top buzzers in trade right now. Mahima.
Right, so it's a mix of stocks which are buzzing on the back of earnings as well as, pre-budget. There are some trades being taken in certain sectors. To start with, Idea Forge is the top gainer today, buzzing ahead of budget, and the stock did see a significant tanking post its earning. So there is some, buying there seen. Now the second one is Prestige Estates. This is on the back of a Jeffries note, which has upgraded Prestige Estates to buy from underperform and has raised the target price to 1600 versus 1420 earlier. What they're saying is that the large capex program is on track for the company and providing headroom for scale up going ahead. The next one on the list is MedPlus Health Services. This is buzzing on the back of its earnings again. Margin expansion was on account of increased contribution from private labels, is because of which the stock is buzzing in trade today. The next one is Inox Wind, again on the back of earnings, where revenue was up 81%, EBITDA up 123%. Margins have improved from 18.4 to 22.7. Net profit up 116 from a 1 crore amount. In terms of why the EBITDA has seen such a uptick, 82% YOY jump in execution of a 189 megawatt. There was an inventory reversal of around 364 crore and 28% annual drop in EPC, O&M and common infra expenses has taken place. Another set of stocks that is buzzing in trade today is the railway stocks. This is ahead of budget, of course. SJVN, Jupiter Wagons, Titagarh are all buzzing. One separate set of stocks that are buzzing are on the back of potential support for battery energy could have some space in the budget today, which is why we are seeing an uptick in JSW Energy, Tata Power, NHPC, Vari Energies, Adani Green, Amara Raja and Exide Industries. Now, these are the top gainers, of course, but we also have some top losers. The first one being Aster DM on the back of numbers. Their profit was around down due to one-off merger expense, which is why it's seeing hit. Otherwise, the numbers were in line. The revenue was up 10%, EBITDA up 25%, and margins have improved from 15.9 to 18%. The second one is 5-star business, which is taking a hit in trade today, where net profit was up around 26% and total income was up around 28%. And lastly, Karnataka Bank is also seeing some profit booking in trade today after its earnings, where net profit was around 284 crore versus 331 crore. Gross NPA at 3.11%, net NPA at 1.4%, and the net interest income was down by 4%, which is why we are seeing a downtick in that particular stock. So all of these counters either in green or red, but are buzzing today.
Okay, so a lot of buzzers. One of them is actually Wockhardt as well. Let's pull up the Wockhardt stock because it's their new super hit Zenic, which has got a nod and will go into second phase of clinical trials. In fact, we spoke exclusively with Wockhardt chairman Habil Khorakiwala on this wonder drug Zenic. Listen in.
We have just completed phase 3 clinical trial, and this clinical trial establishes Zenic is a superior treatment, which is very rare happening in antibiotic or any drugs. Second is that we should be expecting this drug to launch in India by early next year, and in US maybe middle of next year, because we will be filing in US sometime in middle of this year, and then we expect sometime in the middle of next year to receive approval.
All right, now to our budget masters who are with us in the studio and will be with us through the budget speech and will tell us, based on their expectations that they'll lay out right now, how did the budget fare, if you will. Pranav Sehta, National Leader, International Tax and Transaction Services, EY. Mihir Vora, CIO of Trust Mutual Fund. Both of them with us in the studios. Gentlemen, both of you, thank you so much for joining in. Really appreciate your time. There was a hot debate around what is it that the budget can do within the limited space does it have. Can it overshoot the fiscal deficit target a little bit in order to spur capex demand, etc.? Mihir, initial thoughts.
See, I think there is limited, space for the government to maneuver, especially given the fact that we need to balance investments and infrastructure, etc., versus boosting consumption. So there is a fine balance to be maintained. The good thing is that, at least from the stock market point of view, till say the middle of yesterday, there wasn't much of expectations. Markets have been kind of discounting a lot of slowdown, etc. And just because the Prime Minister made some good comments on the middle class, there was a bit of expectation. But apart from that, I don't think we are going in with too many expectations in the budget. So no bad news will be good news, I would say. Okay. In the budget, and anything else will be a bonus.
I find this interesting. So you're linking that comment, and if you have that soundbite, we should quickly play it as well, where Prime Minister talked about how Goddess Lakshmi will shower her blessings on the middle class as a kind of trigger for the market, that there is going to be a big boost for consumption. Is that the biggest ask right now, Mihir?
I think that's not the biggest task because as far as consumption is concerned, for the rural masses, states are already doing a lot. All the 12 states which have introduced different schemes for women, etc., all put together is already 2 lakh crores of stimulus. They are almost 0.6% of the GDP, which is already being given to women as stimulus. So I think rural-wise, the centre doesn't need to do much in any case.
There are enough of those Ladli, Behna and all those schemes. So
that's almost 2 lakh crores on an annualized basis. So that's a decent stimulus in any case. For the urban middle class, what can be beneficial is you do see some tax breaks, etc., because we are seeing some signs of stress in the urban consumption thing. So anything which boosts sentiment for the urban middle class will be good. But I think more important to see is whether the thrust on central government capex continues, because that's been one of the big drivers of the economy for the last 5 years. We've almost seen 25 to 30% compounded growth in capex spending since 2020, and that's been one of the pillars why we could come over the corona slowdown. I think that still needs to continue because the private sector still hasn't kicked in to the extent required. So a continuation of schemes of government schemes on railways, roads, defence, etc., plus more sectors and larger outlays for the PLI schemes is something that would be more important in my view.
I'm just going to play out that sound clip from Prime Minister, and then we'll ask Pranav Saita whether there is enough space and what is the possibility of those tax cuts we're all anticipating.
मैं मां लक्ष्मी से प्रार्थना करता हूं कि देश के हर गरीब एवं मध्यम वर्ग समुदाय पर मां लक्ष्मी की विशेष कृपा रहे। साथियों, ये देश की जनता ने मुझे तीसरी बार ये दायित्व दिया है और इस तीसरे कार्यकाल का ये पहला पूर्ण बजट है।
Okay, so a couple of things that we need to talk about. I think on the personal tax front, as well as I would say on indirect taxes, the tariff response as well. So Pranav Saita, let me start by asking you about the personal tax front and this idea that the boost to consumption can come with some tax tinkering. We've seen, and tinkering is the word, very, very little here and there, which doesn't actually do much for consumption.
Yeah, I think it's more about the sentiment and the expectation than much ahead of that. But I do feel that something will be done in terms of helping the middle class get a little more boost to consumption. May not be very significant in the ultimate analysis on the pocket of the middle class, but still that helps in terms of the sentiment, as well as the fact that the government is thinking about them. And that's, I think, one thing that will happen. I also do feel that to some extent there will be an impetus given to Make in India, maybe through PLI, indirect taxes, schemes and so on, or maybe through some amount of restoration of a concessional tax regime on manufacturing. I do hope that comes. Since we are talking of expectations, I do hope that something that comes, because across the world we are seeing an impetus being given to domestic manufacturing and so on. So I do feel that will help to a large extent.
Which sectors do you think there's a possibility of seeing this in?
I would feel that this might be across the board, but at least in sectors which can promote a lot of employment generation or job creation. I think that's one thing that the government will want to focus on, to somehow bring about that animal spirits back again. And unless manufacturing is given that fillip, job creation is not going to be easy given our demographics. So I do hope and feel that that's something that they will also focus on.
Mr. Saita, good morning, of course, and it's always great having you. All right.
Sure.
Just wondering, one of the problems for the capital markets has been the incessant outflows. Now, taxation changes can't change that. It needs to be economic conditions. But taxation changes at the margin influence whether or not there are enough incentives out there or disincentives to come in or go out, right? Is there anything that you hope, or is there anything that you fear in the budget, fine print or otherwise, that could have a bearing on this?
I hope not. In fact, I do feel that if they maintain the stability, consistency, clarity, and providing certainty, investments will come in. The chief thing here is to ensure that there is ease of doing business. That's, I think, where the second generation of reforms is really required. Because unless, and the economic survey speaks so much about it, deregulation. I think if that's what happens and the government capex on infrastructure keeps up, which over the last 8-10 months has been a little muted, I think those two things, deregulation and providing the right kind of infrastructure, will be the best fillip that one can give to investments, both foreign as well as domestic investors. Otherwise, even Indian businessmen probably will invest more abroad than in India, is what we are seeing these days. So I do feel that that's something that will be very important. One, keeping the regime stable and predictable, which I think the government has done a good job so far and will continue to do that. Second, capex, which has been great over the last few years, but the last 8-10 months have been really very tepid, and that I think needs to pick up, government capex infrastructure building. And third is, as I said, to some extent ensuring that deregulation and the next generation of reforms, for which also I think that taking states along will also be very important and critical. So somehow building that consensus which they built, I think when they brought in GST to a large extent, that consensus building and taking states along, because that's where a lot of the next generation of reforms will have to come as well from, whether it is land, labor, some of the infrastructure and so on and so forth.
That's an important point because in some sense, what states do or don't do has a large bearing right now on how the economy does, because there is a red alert out there on the fiscal health of a lot of states who are doling out freebies currently in order for political compulsions, if you will. So what to your mind is arguably one of the most important things to watch out for from this perspective in the budget, if at all?
See, ease of doing business can't be addressed in the budget. It has to be built, based on consensus and taking the states along. I think, but even more important is how to eliminate the real grassroots level harassments. I think that's a key part of ease of doing business, and that's what needs to be addressed in terms of, I don't know, governance structures or reforms, anti-corruption movement. So, in fact, if that improves, I don't even think we need PLI. So PLI essentially directly or indirectly is a cost of or trying to make up for all these inefficiencies at the grassroots level. So I think that would probably require more of a mindset change rather than any thing in the budget or fiscal incentives, I would say.
Yeah, but just to that point, Neeraj, now either you look at subsidies as a red flag or you look at them as a consumption boost, because in the course of this conversation we've ended up looking at it both ways. For now, at least, if that's what's propping up the economy to some extent, wouldn't that at least be a positive from a market's perspective?
See, subsidies are now going to be a global phenomenon in my view.
A global phenomenon,
because I think the end game everywhere is the world, especially the developed countries, are so much deep in debt that the only way out structurally is to inflate their way out of the problems, whether it's the US or Europe, anything, right? Which will mean that you will see asset prices, continue to be high. Inflation will be there structurally as a sticky way, and which will mean that the lower income category, population will have to be directly or indirectly subsidized, whether it's UBI or, as we saw in COVID, the US was giving $1,000 checks to people. I think that will have to continue because inflation is going to be sticky, especially in the places where you have seen so much debt building up. Even, for example, President Trump's measures to, introduce import duties will, initially at least, till the time you have US ramping up its own manufacturing, initially it will be inflationary in nature. So that's going to be a structural issue. As we speak, in the last couple of months, again we have seen food grains, etc., prices go up. FMCG companies already talking about raw material price increases.
Yeah.
So I think inflation is not going to go in a hurry, which means that subsidies will be a structural part of any economy.
No, just on the tariffs bit, and I wanted to get your view, Mr. Saita, because we did a story that we're expecting in this budget a custom duty drop on 7 to 8 items imported from the US. It's, in a sense, perhaps you can look at it as a preemptive move as all of this tariff talk goes on. What does India need to do to be on the right side of this tariff trade war, this global tariff war which is going to erupt?
I would feel that yes, some definitely signals might come along, but primarily anything that we do will be measured. I would feel we would wait for what exactly US comes up with, and I don't think India is on the top of the list of countries which will face the heat of tariffs.
Yeah.
So we would wait, I think, to see how it goes along. But yes, any and every items which are primarily inputs where India is value adding on that and sending out again, particularly, I think that's where we will see definitely tariffs coming down.
I think our fight is not really with the US.
Yeah.
The duties have to be with China, right? Imports from China is the bigger one.
Yeah, but just that, I think, so we've done a small exclusive 3-4 days back. It's a very small, tiny item, but 7 or 8 key items from the US might see some bit of duty changes.
Right.
Maybe it's ahead of the Trump-Modi meet or Modi-Trump meet, as the case
Symbolic.
may be. Symbolic in nature, but yeah, something like that to come out as well. So pretty interesting things that might happen.
Yeah,
Right.
yeah. Ramdev Agarwal joining us on the conversation this morning, Chairman and co-founder of Motilal Oswal Financial Services. Mr. Agarwal, thank you so much for speaking with us here at NDTV Profit. Absolute pleasure on what is turning out to be perhaps an exciting morning, more optimistic than we would have thought at the start of this week.
Hello, yeah. Good morning. So clearly things are kind of evenly balanced, and there's a lot of hope that the FM is going to shower goodies for the middle class and women class. That looks to be what even PM's expectation is. So I would think that the commitment to what you call Viksit Bharat, that's coming out very clearly, and one of the ways to increase the GDP growth rate from say 6.5% to maybe 7.5% would be the giving some kind of incentive to the middle class for consumption. That looks to be the theme right now.
And do you think that that's the single most important perspective? I'm just wondering, on a budget morning, and we're speaking half an hour before the budget, what does a Ramdev Agarwal have on his checklist to look at? Will you be looking at the capex figure, the fiscal deficit figure? What is that top point that you're looking at?
Yeah, so I've noted down 3 points. One is the middle class, what exactly they end up doing for the middle class, and where FM has said, clearly PM knows what exactly is going to come. So his wishes are around middle class and women class and poor. So clearly we are going to see some bundle of measures out there, whether it stands up to anything in the market or not, that's one thing. Second is the commitment to 8% growth, whatever it takes. I mean, it is for the leadership to say that we are committed to 8% year on year. There will always be some cost here and there, but growth solves a lot of problems. So how committed they are, bureaucracy as well as the policymakers and leadership, to 8% thing. Third, the credit flow. I think one of the biggest things which has hurt the economy in last 12 months, in my limited understanding, is the credit flow into the entire economy, which has come down from 15-16% to 10-12%. If we remain at 10-11%, do whatever, I don't think we'll ever touch 6.5%. That's my sense.
Okay. Mr. Agarwal, good morning. Neeraj here. I love the backdrop, budget bullets, maybe dodge any bullets that might come our way if they do. But here's my question, sir. One of the things that some of the panelists have stated today, of course, the unequivocal focus on growth, and therefore, if the FM and the government, or the FM in her wisdom, decides to deviate a little bit from the fiscal glide path, if that shows an intent to invest for growth or creating demand. So if the next year's number is not 4.5, right, and it says that it is being done to stimulate growth. Will the markets take it well, or will the markets be disappointed?
I don't know about the market, but I'll be very happy. In the sense that, to me, growth is paramount, and if you can do fiscal, to me, if you can do the growth and then consolidate fiscally, that will be very good. But I would not put fiscal consolidation as a priority over the growth. Because once growth comes, even fiscal consolidation is possible because your tax revenues, they get boosted.
Okay, that's one. And something that I'll ask Mir Vora also, but just a follow-up question to that, Mr. Agarwal. We want to do a lot of things. There is very limited resources as well. This time around, we know that this year the revenue picture also has not looked that strong, right? So let's assume the fiscal path is maintained, if you will. There is not, I mean, we haven't done enough capex, and let's assume that number stays as is and doesn't really increase too much, if you will, and therefore misses the budgeted estimates too. Will that be a disappointment, or will that be a need of the hour because revenues also have been lower?
I mean, let's see the actual number, what comes out. My sense is that if they're able to boost the GDP growth and nominal GDP growth rate, even if with a little higher inflation of about, say, 5%, I think they will have enough revenue. And so they will have enough resources if they want to do, if they want to maintain and actually increase nominally the capital expenditure. Because the best place where the capital expenditure will give rewards to the economy is going to be infrastructure, and that only government can do. So clearly the momentum which we are seeing in last few years, where government is coming very aggressively onto the infrastructure side, that momentum should be maintained. And if anything, whatever was the budgetary provision last year, the next year should be somewhat higher, at least 10-12% nominally, so that it may remain percentage of GDP same, but nominal value will be 8-10% higher.
The other piece, Mr. Agarwal, that from a market's perspective, what does it look to? The last few years have seen this unequivocal focus towards creating manufacturing assets, giving PLI schemes, etc. That may well continue. But if there are tax changes or other changes done in order to boost consumption, all right, and boost household income, does it change the texture of the market in that the market starts rewarding consumption themes, staples, what have you? And is that fair too?
See, Neeraj, actually market is looking for earnings growth. I mean, from whichever sector it comes. It is not necessary from the only consumption side the earnings growth should come. If aggregate earnings growth, which is now flattened from last year 1,000 rupees EPS for Nifty, it has come to about 1,050 for the current year. Next year, if it doesn't scale up to 10-12% from 1,050 to say more like 1,200 or 1,150, I think market will not be excited. So it doesn't matter from which sector it comes, whether it comes from infra side, consumption side, energy side, you take your pick from which side it comes. But my aggregate earnings growth should be more like, I'm speaking as a capital market guy. If my earnings growth next year looks to be, my head of research revises the earnings growth projection for 25-26 to by 12 to 15%, that will be the big day, whether it comes by tax cut, whether it comes by earnings growth, I mean per se top line growth, or margin expansion, that is all. But 12 to 15% earnings growth next year is almost a must to hold the markets at 23,000.
Okay, I know I'm just on earnings growth, Mr. Agarwal. Want to get your view. Have you, if there's a scale of disappointment or optimism, how are you feeling from what you've seen so far? Because Q3 and second half was supposed to be the better picture being painted. This is what we all heard in the end of Q2. What have been your thoughts when you've seen the earnings growth? Because at the end of the day, budget will go one day affair. After that, you will have Trump doing whatever Trump does. But this is the core number that we need to watch.
Yeah. So clearly last year, thanks, I mean, if you see the economic survey, Mr. Nirmala has gone about saying that the slowdown is not structural, it's seasonal, in the sense that because of elections, the capex, the government capex slowed down, at least in the first 9 months. And that has led to whatever Q3 5.4% or somewhat like that. It's not a structural slowdown in the economy, it is more of a seasonal. And that's why he is, in one of the interviews I heard yesterday, he said, of course in the economic survey is written that their expectation is about 6.3 to 6.8, but he is the guy who is insightful today because he has written the whole thing. So my sense is his expectation of about 7% for 25-26, I would think that he would be on the right line of thinking. And if that 7% comes with 4.5-5% inflation, I think we'll have good time. In the sense that corporate earnings will pick up by more than 12 to 15%.
Got it. Mr. Agarwal, I have one final question, and that is not necessarily budget linked, but you could argue it's budget linked. And I'm saying that let's assume the budget dishes out most things that you say, if not all. I would love to know at the start of 2025, how bullish, bearish, neutral is Ramdev Agrawal from a 12-month perspective? I know you're very bullish over the long term. Just trying to think for the slightly shorter term, which is 12 months.
Yeah. So 12 months looks to be, I would not be very bullish, let me tell you. I would be a little more on cautionary basis, in the sense that I would expect about first half I would not be that bullish, but second half I'll be very, very bullish. So on the whole, for the year, with little pain in the beginning, I think we should do well. And so I would be cautiously optimistic for 25-26, particularly back-ended.
I want to get your view, Mr. Agarwal, on what we've been seeing in terms of tariffs. And while, if I would look at it from three factors: one, what the government does; one, what corporate India does in terms of its earnings and its performance; and then one is geopolitical. And geopolitical factors are going to be dominated by tariffs. All the announcements this morning, how did you look at it? And is this an opportunity for India or a threat?
I think it will be both ways, in the sense that I think it will be more of an opportunity, because the big daddy in the global manufacturing is China. And if China is being restricted, clearly the tenor of Trump's tariff policy looks to be make Chinese imports a little uneconomical, so that the local manufacturing becomes a little more viable. To that extent, if there is not so much of tariff on Indian imports, probably it will be a huge tailwind, longer term tailwind for Indian manufacturers to step up their effort and export a lot more to the US. But that looks to be pretty, simple analysis of what is going to come. It's a very complex thing. We have to play as it comes. So let's not speculate anything till final things have come.
Okay, fair enough. We don't know yet. If tariffs for China, good for India, we don't know what's going to happen from the Indian perspective. But in the context of this budget, Mr. Agarwal, what do you think we need to see? Would you wait to hear some clear policy direction there?
Yeah, so clearly, as I said, their ultimate North Star is the Viksit Bharat by 2047. And it is very well clearly laid out that compounded growth of about 8% is required. We are at about less than 6% right now, as it turns. So you have to have very, very clear policy guidelines. And where there is will, there is a way. And once Mr. Modi has set his eyes on Viksit Bharat and 8% growth, all the forces and the policy making will come together, whether it is a deregulation of the businessman or ease of doing business, regulators coming, little soft pedaling on the operators. Say like credit flow into the economy. Once you slow down the credit flow into the economy, a lot of other measures don't work. So I think first they have to do the plumbing of increasing the credit flow into the economy. And that, I think, at least economic surveys talked about it. Let's see whether it comes or not. Or maybe it may not be in the budget, but at least follow on to the budget. There could be rate cut, there could be, I would expect a lot more monetary action than the fiscal action as we go forward in next 1 month.
Just, I know we've been saying one last for a while, but this is really the last one. I'm just wondering, how are you looking at the pain point in the markets right now? And do you see Feb 1st and then Feb 7th after the monetary policy opportunity for a pivot here? Just wanting to get what's in your head right now when you think about where Indian equity is going.
Yeah. See, broader market last year, actual portfolios did very well, like anywhere between 35 to 40, 50% return on the back of the broad index doing just about 8-10%. So clearly we have beaten the index last year. This year, I think index will come and beat us all. So most likely, it will be very tough for most of the active managers to beat the broad index. And hence, there could be a churn from mid and small to large cap. But that happens only when foreigners, they start buying big time, because they love to buy large cap, and large cap valuations have become very reasonable. So let's see when the tide turns, and it turns when you don't expect it. So quite possible times are coming when things may change and surprise us the pace at which it changes. So I would think that there are a lot happening in the Indian economy. Large caps are reasonably priced. Mid and small are still slightly elevated, and that IPO market is kind of bringing it down one by one, because the offerings are there relentlessly. So it's one of the hottest IPO market. I think one of the things which I didn't say, and I think it didn't come even in the economic survey, is the flow of the risk capital, unprecedented flow of risk capital in the economy. If it is harnessed well, it can change the complete trajectory of economic growth and the pace at which we can develop. So that is what is going to happen in next 1 or 2 years, and I would like to see how the FM helps that flow and uses that risk capital flow into the economy very, very creatively.
Well, let's hope a lot of these wishes turn out to be true. Mr. Agarwal, thank you so much for joining in today and giving us your thoughts. Really appreciate your time.
Thanks.
All right, that's an important market view from Ramdev Agrawal of Motilal Oswal. And just before we ask the follow-ups to some of these points, and in fact, I think the points collaborated between what Mr. Sehta said, what Mihir Vora said, and what Mr. Agarwal had to say. But before we do that, just a quick perspective from our research team as well, which has been waiting to talk about what should you watch out for ahead of the budget. Remember, it's not a bad market in that we are at about 1/3% in the green ahead of the budget, and small caps continue to trudge higher. In fact, it's not a trudge really. With the 1.7% gain yesterday and the 1% uptick today, small caps are really doing well. What are the stocks to watch ahead of the budget? Somit is here with a list of some of those. Somit, tell us the names and why you have chosen those.
Well, firstly, top on the list is ITC, because in the last 3 budgets we have not seen any major tax hike related to cigarette come in, and so Street is expecting that there would be definitely a tax hike on cigarettes this time. So if it's a double-digit tax hike, then definitely it's negative for ITC, but a mid to high single-digit tax hike would be neutral, and a low single-digit tax hike would definitely be positive for ITC. Apart from that is the capital goods and road infra companies like L&T, IRB Infra, Dilip Bilcon, that would be in focus. Now the Street is saying that if the capital expenditure growth is less than 15%, then it could be negative for the capital goods and the road infra companies. Then there are rural focused companies like Imami, Dabur, Jyoti Labs, Chambal Fertilizers, GSFC, M&M Finance and L&T Finance. So any increased allocation towards rural spending, agriculture spending, rural schemes would definitely be positive for these rural focused companies. Then there are housing finance companies like PNB Housing, LIC Housing, Awas Housing. All these stocks would remain in focus, because any increased allocation towards CLSS scheme, that is the housing scheme, or PMAY scheme would definitely be positive for this housing finance companies. Then there are oil marketing companies like IOCL, BPCL and HPCL, and these stocks would definitely remain in focus given the fact that they have incurred huge LPG subsidy losses in FY25. So any lower allocation towards subsidy, LPG subsidy would definitely be negative for the oil marketing companies. And lastly, it's Adani Green, Tata Power and Wari Renewables. All these stocks would remain in focus because government has clearly showed their focus or intent towards increasing solar energy. So any increased allocation towards rooftop solar would definitely be positive for Adani Power, Wari Renewables and Tata Power.
for that, Samit. So those are some of the stocks that you should look at, and some of them have already run up actually in anticipation. There's just about 13 minutes left for the speech to start. We're taking a very short break and coming right back. How do you set up for trade in this last bit before the speech? Stay tuned for that and more. This is the day that shapes the future of 1 billion dreams.
From the fields of agriculture to the backbone of defense.
From ambitious infrastructure projects to everyday tax policies.
Every decision counts.
How will this budget balance growth and fiscal prudence?
What will it mean for jobs and what will it mean for your portfolio?
Join us for the most comprehensive coverage of Budget 2025
as we decipher the impact
of this budget on you. STT. STT definitely needs to change.
Old tax regime.
The 1991 budget was truly a game changer.
I mean, the rest is history.
Union budget.
budgets.
General elections.
Union budget.
Two more, Yashwant Sinha and P. Chidambaram.
Arun Jaitley.
Arun Jaitley, I'd have to say.
I think Manmohan Singh for sure because of the iconic 1991 budget speech.
STT. STT definitely needs to change because now if returns are not that good, it'll start pinching people.
Income tax.
I think income tax because that's what matters to me.
Old tax regime.
Depends. Old tax regime currently.
I would say healthcare and education.
I'd believe infra.
Oh, certainly more allocation towards infrastructure. That's what's keeping the wheels turning right now.
Game changer, but not in a positive way, was the budget when farm loans were waived off.
There are a couple of them actually. 1991, Manmohan Singh, that was the budget which opened up the economy. Then 97, Chidambaram, who reduced the tax rate from 40.
Welcome back. Thanks so much for tuning in, staying tuned to NDTV Profit. Now, this is something that has come up in conversation in the last 1 hour, 15 minutes. And that is it okay to miss the fisc glide path targets if the intent is to spur growth? And Mihir Vora, you look at these numbers very, very closely, right? The fisc deficit, the income that the government has, the fixed expenditures, etc. One, does the government have enough headroom for FY26, not just FY25 by the way, to keep that momentum on capex example and at the same time boost consumption? And if it does not, is it okay to miss the fisc deficit glide path target for FY26 if they are doing it in the right spaces, which makes the market believe that they are wanting to spur growth? And what would you have, even if they have the budget, or even if they have the numbers, is it prudent to do that or would you not want it?
See, I don't think the RBI and the government are in a mindset to deviate too much from the glide path that has been shown to the market, because I think we as a country are very conscious about the fact that we tried so hard to get into the global bond indices, and that does come with some kind of soft commitments and understandings about where the fiscal direction should go. So the mindset is not really to deviate, that's one. Having said that, if you look at the tax collections and if you introduce a little more discipline in the taxation regime, there is a scope for tax to GDP to go up. In spite of having introduced GST, etc., the tax to GDP ratio is creeping up very slowly. So there is a scope for better compliance, better this thing, not terrorism but compliance, right? There is scope there. So I'd rather that they focus on increasing the tax to GDP rather than increasing taxes. And if we can get a nominal GDP growth of closer to 12% rather than 10.5%, then there will be scope for extra spending, I would say.
Okay, Mr. Sethap, just the same question to you really.
Yeah. So I don't think they will want to miss the fiscal deficit number for next year as well.
Yeah.
Maybe year thereafter, because of the 8-pay commission, this, that, there might be some aberration. But at least for next year, I think they'll still stay with the fiscal deficit number. At the same time, I do feel that they will want to bring growth much higher than what we are currently seeing. And while it's a wish, I'm not sure whether it will happen. If it means that government capex, in order to be maintained, needs some revenue, I think the best course and the correct course for them to take would be more aggressive on the disinvestments. I think, while I'm not sure they will do it.
Believe it, sir.
Sorry?
While the market even believe that if they're aggressive, because they are not meeting the targets even for this year, right? Or the last year, or the year before that, what have you?
Yes. So the point that I'm trying to make is what they ought to do.
Okay.
And probably if they do this, they should not give up on infrastructure building, government capex, because that's what will crowd in even private investment.
Sure.
But giving up on growth would be a bad idea, because taxes will really come from growth as well. The buoyancy in taxes will come to a large extent also from growth. So I don't think they should sacrifice growth. They will not want to sacrifice fiscal deficit. So I am trying to say that if you sacrifice growth, in any case taxes will come down and fiscal deficit will be a problem. So you must maintain growth, and if that requires disinvestment, but capex, government capex has to be there. So that's the way I would feel they should balance their books. But government capex should not be sacrificed. Fiscal deficit they won't, and I think they should not. We've tasted the fruits of a good macro stable environment, and I don't think they'll want to give that up very easily.
Just some of the focus areas that we need to look at, and Mihir, let's get, we have 5 minutes to go for the speech, so let's get a little specific on the markets just for a bit. And we were speaking in the break about how a lot of people just don't want to trade on the budget day, but there are a lot of people who do, and many of them watching us right now. Thank you for all your views, even on our YouTube stream. Just trying to understand whether the typical rail, solar energy, defense push is something that is a safe play this morning.
100%, because these are structural plays and the direction is very clear, whether it's indigenization of defense manufacturing, whether it's the shift from coal and non-renewables to renewables. So those are structural changes and those are not going to go away. So irrespective of the budget, these are certain themes which are going to be there for the longer term, I would say.
Okay, and if the budget gives focus, that's an added impetus.
That's an added impetus. Absolutely.
Okay. So, well, watch out for that bucket, if you will, of pockets wherein there has been the continued focus and that continues too as well. Mr. Setha, you're not a markets person, but very, very quickly, if there is some tax changes, etc., in order to spur consumption, you think that would be a welcome move? And does that spur the sentiment around consumption?
Absolutely, I think so.
Okay, so interesting piece on, and this budget important because the last budget was in July, and Mihir, you walked in and said budget phir se aa gaya itna jaldi. That sets up perfectly for this piece that our colleague Hiral has done, where she's tracked markets since the last budget in July and today. Important because what a change in mood since these two events. Take a look.
If we can just move to the key 9 aspects which the markets had considered, which the budget 2024 had considered, that will be key. Firstly, disappointed investors, as Neeraj also mentioned, however, rewarded some taxpayers, right? So that was one of the key focus areas. But there were 9 things that Nirmala Sitharaman actually looked at. One was productivity and resilience with regards to agriculture. So schemes with agriculture that were announced. Employment and skilling was their next focus area. Moving on, the others were in terms of inclusive HR development and social justice, manufacturing and services where PLI schemes were announced to some extent. Urban development was the other aspect, and energy security with renewables was one of the focus areas. Infrastructure, which is the crux, capex has been slowing down. What do they do from here on? Innovation R&D was again what they focused on as well. And very lastly, if you see in terms of next generation reforms. Now, whether all of this has actually helped markets or not, absolutely not. Nifty, a downtick of 5% since the previous budget, where you had broader markets which actually went ahead and underperformed as well to the tune of almost around 7 to 9.5%. So that's the mid cap and the small cap underperformance. Now, very interesting. The performance tells you that the markets were not happy because all your domestic oriented sectors were the ones which have underperformed. From energy to oil and gas, real estate, PSU banks and FMCG, down to the tune of almost around 11 to 21% from the previous budget to now. What has outperformed? It's your export-oriented sectors, Nifty IT, Nifty Pharma, up to the tune of almost around 3 to 6%. So you clearly know that it's the domestic policies which have not really been working for India Inc. It's the export-oriented ones. And similar is the trend if you see in terms of gainers and losers. From a TV slab to Wipro, Bajaj Finance, Holdings and a Bharti Airtel, gains to the tune of almost 12 to 26% that did come in. What was losing? Adani Green did lose out. Yes, there was a Hindenburg impact coming in there. But you had a BHEL, IndusInd Bank, Tata Motors, JSW Energy, all in the range of around 30 to 36%, which were under pressure. Let's look at the broader markets. If you see Nifty 500, you have 366 stocks that have actually given negative returns since the previous budget out of Nifty 500. So that tells you the quantum of underperformance that has come in there. And if you talk about the mid-cap companies, BSE actually is outperformed with gains of nearly 2.3 times. But Lloyds Metal, Paytm, Coforge, Dixon, these are the ones which were losing to the tune of around 30 to 75%, gaining, I beg your pardon, to the tune of 30 to 75%. Whereas names like Cochin Shipyard, Vodafone Idea, MRPL, SJVN, Exide Industries, all down in the range of around 35 to 45%. Small caps, you have Amber Enterprises, Piramal, KFin Tech, Aster DM, MCX, all up in the range of 40 to 50%. Whereas if you see in terms of the losers, if you can have that slide, there you go. Honasa, Sterling, Chennai Petro, Tanla, Jupiter, these were the names which were losing out. So that's in terms of the performance, but let's also look at a few of the other reasons which impacted the markets. You had the largest ever FI sell-off that came in to the tune of almost around 2.7 lakh crore. Secondly, you have analysts who have gone ahead and cut estimates as well with regards to earnings for FY25 and 26. Apart from that, if you talk about the geopolitical concerns, they have been looming on the domestic markets. And very lastly, if you see in terms of the election year, that has seen lower government spends.
Okay, first visuals coming in from Parliament. And the customary noise around it as well. Remember, it's also the start of the budget session. Honorable Speaker in the chair, let's listen in.
राज्यपाल अभिभाषण पर चर्चा होगी। 9 development. C. Invigorate private sector investments. D. Uplift household sentiments. And E. Enhance spending power of India's rising middle class. Together, we embark on a journey to unlock our nation's tremendous potential for greater prosperity and global positioning under the leadership of Honorable Prime Minister Shri Narendra Modi. As we complete the first quarter of the 21st century, continuing geopolitical headwinds suggest lower global economic growth over the medium term. However, our aspiration for a Viksit Bharat inspires us, and the transformative work we have done during our government's first 2 terms guides us to march forward resolutely. Our economy is the fastest growing among all major economies. Our development track record for the past 10 years and structural reforms have drawn global attention. Confidence in India's capability and potential has only grown in this period. We see the next 5 years as a unique opportunity to realize Sabka Vikas, stimulating balanced growth of all regions. The great Telugu poet and playwright Gurujada Apparao had said, "Deshamante matti kadoy, deshamante manushuloy," meaning a country is not just its soil, a country is its people. In line with this, for us, Viksit Bharat encompasses zero poverty, 100% quality good school education, access to high quality, affordable and comprehensive health care, 100% skilled labor with meaningful employment, 70% women in economic activities, and farmers making our country the food basket of the world. In this budget, the proposed development measures span 10 broad areas focusing on Garib, youth, Annadata and Nari. Spurring agricultural growth and productivity, building rural prosperity and resilience, taking everyone together on an inclusive growth path, boosting manufacturing and furthering Make in India, supporting MSMEs, enabling employment-led development, investing in people, economy and innovation, securing energy supplies, promoting exports and nurturing innovation. For this journey of development, our 4 powerful engines are agriculture, MSME, investments and exports. The fuel, our reforms, our guiding spirit, inclusivity, and the destination, Viksit Bharat. This budget aims to initiate transformative reforms across 6 domains. During the first 5 years, these will augment our growth potential and global competitiveness. The domains are taxation, power sector, urban development, mining, financial sector, and regulatory reforms. Agriculture as the first engine. Now I move to specific proposals, beginning with agriculture as the first engine. Prime Minister Dhan Dhanya Krishi Yojana, developing agri-districts program. Motivated by the success of the aspirational district program, our government will undertake a Prime Minister Dhan Dhanya Krishi Yojana in partnership with states. Through the convergence of existing schemes and specialized measures, the program will cover 100 districts with low productivity, moderate crop intensity, and below average credit parameters. It aims to 1. Enhance agricultural productivity, 2. Adopt crop diversification and sustainable agricultural practices, 3. Augment post-harvest storage at the panchayat and block level, 4. Improve irrigation facilities, and 5. Facilitate availability of long-term and short-term credit. This program is likely to help 1.7 crore farmers. Building rural prosperity and resilience. A comprehensive multi-sectoral rural prosperity and resilience program will be launched in partnership with the states. This will address underemployment in agriculture through skilling, investment, technology, and invigorating the rural economy. The goal is to generate ample opportunities in rural areas so that migration is an option but not a necessity. The program will focus on rural women, young farmers, rural youth, marginal and small farmers, and landless families. The details are in Annexure A. Domestic best practices will be incorporated, and appropriate technical and financial assistance will be sought from multilateral development banks. In Phase 1, 100 developing agri-districts will be covered. Atmanirbharta in pulses. Our government is implementing the National Mission for Edible Oilseed for achieving Atmanirbharta in edible oils. Our farmers have the capability to grow enough for our needs and more. 10 years ago, we made concerted efforts and succeeded in achieving near self-sufficiency in pulses. Farmers responded to the need by increasing the cultivated area by 50%, and government arranged for procurement and remunerative prices. Since then, with rising incomes and better affordability, our consumption of pulses has increased significantly. Our government will now launch a 6-year mission for Atmanirbharta in pulses with a special focus on Tuar, Urad and Masoor. Details are in Annexure B. Central agencies such as NAFED and NCCF will be ready to procure these 3 pulses as much as offered during the next 4 years from farmers who register with these agencies and enter into agreements. Comprehensive program for vegetables and fruits. It is encouraging that our people are increasingly becoming aware of their nutritional needs. It is a sign of a society becoming healthier. With rising income levels, the consumption of vegetables, fruits, and Shri Anna is increasing significantly. A comprehensive program to promote production, efficient supplies, processing, and remunerative prices for farmers will be launched in partnership with the states. Appropriate institutional mechanisms for implementation and participation of farmer producer organizations and cooperatives will be set up. Makhana board in Bihar. For this, there is a special opportunity for the people of Bihar. A Makhana board will be established in the state to improve production, processing, value addition, and marketing of Makhana. The people engaged in these activities will be organized into FPOs. The board will provide hand-holding and training support to Makhana farmers and will also work to ensure they receive the benefits of all relevant government schemes. A national mission on high-yielding seeds will be launched, aimed at 1. Strengthening research ecosystem, 2. Targeted development and propagation of seeds with high yield, pest resistance, and climate resilience, and 3. Commercial availability of more than 100 seed varieties released since July 2024. India ranks 2nd largest globally in fish production and aquaculture. Seafood exports are valued at 60,000 crore rupees. To unlock the untapped potential of the marine sector, our government will bring in an enabling framework for sustainable harnessing of fisheries from Indian Exclusive Economic Zone and high seas, with a special focus on the Andaman and Nicobar and Lakshadweep Islands. For the benefit of lakhs of cotton growing farmers, I am pleased to announce a mission for cotton productivity. This 5-year mission will facilitate significant improvements in productivity and sustainability of cotton farming and promote extra long staple cotton varieties. The best of science and technology support will be provided to farmers. Aligned with our integrated 5F vision for the textile sector, this will help in increasing incomes of the farmers and ensure a steady supply of quality cotton for rejuvenating India's traditional textile sector. Kisan credit cards facilitate short-term loans for 7.7 crore farmers, fishermen, and dairy farmers. The loan limit under modified interest subvention scheme will be enhanced from 3 lakh rupees to 5 lakh rupees for loans taken through the KCC. For Atmanirbharta in urea production, our government had reopened 3 dormant urea plants in the eastern region. To further augment urea supply, a plant with annual capacity of 12.7 lakh metric tons will be set up at Namrup in Assam. India Post, with 1.5 lakh rural post offices, complemented by the India Post Payment Bank and a vast network of 2.4 lakh Dak Sevaks, will be repositioned to act as a catalyst for the rural economy. Details are at Annexure C. India Post will also be transformed as a large public logistics organization. This will meet the rising needs of Vishwakarmas, new entrepreneurs, women, self-help groups, MSMEs, and the large business organizations. Our government will provide support to NCDC for its lending operations for the cooperative sector. MSMEs as the second engine. Now I move to MSMEs as the second engine, which encompasses manufacturing and services with a focus on MSMEs numbering 5.7 crores. Currently, over 1 crore registered MSMEs, employing 7.5 crore people and generating 36% of our manufacturing, have come together to position India as a global manufacturing hub. With their quality products, these MSMEs are responsible for 45% of our exports. To help them achieve higher efficiencies of scale, technological upgradation, and better access to capital, the investment and turnover limits for classification of all MSMEs will be enhanced to 2.5 and 2 times respectively. This will give them the confidence to grow and generate employment for our youth. The details are given in Annexure D. To improve access to credit, the credit guarantee cover will be enhanced. First, for micro and small enterprises from 5 crore to 10 crore rupees, leading to additional credit of 1.5 lakh crores in the next 5 years. Second, for startups from 10 crore rupees to 20 crore rupees, with the guarantee fee being moderated to 1% for loans in 27 focus sectors which are important for Atmanirbhar Bharat. And for well-run exporter MSMEs, for term loans up to 20 crore rupees. Also for the micro enterprises, we will introduce customized credit cards with a 5 lakh rupee limit for micro enterprises registered on Udyam portal. In the first year, 10 lakh such cards will be issued. Fund of funds for startups. The Alternate Investment Fund, AIFs, for startups have received commitments of more than 91,000 crores rupees. These are supported by the fund of funds set up with the Government of India's contribution of 10,000 crore rupees. Now, a new fund of funds with expanded scope and a fresh contribution of another 10,000 crore rupees will be set up. A new scheme will be launched for 5 lakh women, scheduled castes and scheduled tribes, first-time entrepreneurs. This will provide term loans up to 2 crore rupees during the next 5 years. The scheme will incorporate lessons from the successful Stand Up India scheme. Online capacity building for entrepreneurship and managerial skills will also be organized. Measures for labor-intensive sectors. To promote employment and entrepreneurship opportunities in labor-intensive sectors, our government will undertake specific policy and facilitation measures. To enhance the productivity, quality, and competitiveness of India's footwear and leather sector, a focused product scheme will be implemented. The scheme will support design capacity, component manufacturing, and machinery required for production of non-leather quality footwear, besides the support for leather footwear and products. The scheme is expected to facilitate employment for 22 lakh persons, generate over 4 lakh crore rupees, and exports of over 1.1 lakh crore rupees. Measures for the toys sector. Building on the National Action Plan for Toys, we will implement a scheme to make India a global hub for toys. The scheme will focus on development of clusters, skills, and a manufacturing ecosystem that will create high-quality, unique, innovative, and sustainable toys that will represent the Made in India brand. Support for food processing. In line with our commitment towards Purvodaya, we will establish a National Institute of Food Technology, Entrepreneurship and Management in Bihar. The institute will provide a strong fillip to food processing activities in the entire eastern region. This will result in 1. Enhanced income for the farmers through value addition to their produce, and 2. Skilling entrepreneurship and employment opportunities for the youth. Manufacturing mission, furthering Make in India. Our government will set up a national manufacturing mission covering small, medium, and large industries for furthering Make in India by providing policy support, execution roadmaps, governance, and monitoring framework for central ministries and states. Details are in Annexure E. Given our commitment to climate-friendly development, the mission will also support clean tech manufacturing. This will aim to improve domestic value addition and build our ecosystem for solar PV cells, EV batteries, motors and controllers, electrolyzers, wind turbines, very high voltage transmission equipment, and grid scale batteries. Investment as the third engine. Now I move to investment as the third engine, which encompasses investing in people, investing in the economy, and investing in innovation. Investing in people. Saksham Anganwadi and Poshan 2.0. Saksham Anganwadi and Poshan 2.0 program provides nutritional support to more than 8 crore children, 1 crore pregnant women and lactating mothers all over the country, and about 20 lakh adolescent girls in aspirational districts and the Northeast region. The cost norms for these nutritional support will be enhanced appropriately. Atal Tinkering Labs. 50,000 Atal Tinkering Labs will be set up in government schools in the next 5 years to cultivate the spirit of curiosity and innovation and foster a scientific temper among young minds. Broadband connectivity to government secondary schools and PHCs. Broadband connectivity will be provided to all government secondary schools and primary health centers in rural areas under the BharatNet project. Bharatiya Bhasha Pustak Scheme. We propose to implement a Bharatiya Bhasha Pustak scheme to provide digital form Indian language books for schools and for higher education. This aims to help students understand their subjects better and in their language. National Centers of Excellence for Skilling. Building on the initiative announced in the July 24 budget, 5 National Centers of Excellence for Skilling will be set up with global expertise and partnerships to equip our youth with the skills required for Make for India, Make for the World manufacturing. The partnership will cover curriculum design, training of trainers, and a skills certification framework and periodic reviews. Expansion of capacity in IITs. Total number of students in 23 IITs has increased 100% from 65,000 to 1.35 lakh in the past 10 years. Additional infrastructure will be created in the 5 IITs started after 2014 to facilitate education for 6,500 more students. Hostel and other infrastructure capacity at IIT Patna will also be expanded. Center of Excellence. Center of Excellence in AI for Education. I had announced 3 centers of excellence in artificial intelligence for agriculture, health, and sustainable cities in 2023. Now a center of excellence in artificial intelligence for education will be set up with a total outlay of 500 crores. Expansion of medical education. Our government has added almost 1.1 lakh undergraduate and postgraduate medical education seats in 10 years, an increase of 130%. In the next year, 10,000 additional seats will be added in medical colleges and hospitals towards the goal of adding 75,000 seats in the next 5 years. Daycare cancer centers in all district hospitals. Our government will facilitate setting up of daycare cancer centers in all district hospitals in the next 3 years. 200 centers will be established in 25-26 itself. Strengthening urban livelihoods. Our government has been giving priority to assisting urban poor and vulnerable groups. A scheme for socio-economic upliftment of urban workers will be implemented to help them improve their incomes, have sustainable livelihoods, and a better quality of life. PM Swanidhi scheme has benefited more than 68 lakh street vendors, giving them respite from high-interest informal sector loans. Building on this success, the scheme will be revamped with enhanced loans from banks, UPI-linked credit cards with 30,000 rupees limit, and capacity building support. Social Security Scheme for welfare of online platform workers. Gig workers of online platforms provide great dynamism to the new age services economy. Recognizing their contribution, our government will arrange for their identity cards and registration on the e-Shram portal. They will be provided healthcare under PM Jan Arogya Yojana. This measure is likely to assist nearly 1 crore gig workers. Investing in the economy, public-private partnership in infrastructure. Each infrastructure-related ministry will come up with a 3-year pipeline of projects that can be implemented in PPP mode. States will also be encouraged to do so and can seek support from the India Infrastructure Project Development Fund, which is a scheme to prepare PPP proposals. Support to states for infrastructure. An outlay of 1.5 lakh crore is proposed for the 50-year interest-free loans to states for capital expenditure and incentives for reforms. Building on the success of the first asset monetization plan announced in 2021, the second plan for 2025 to 30 will be launched to plow back capital of 10 lakh crore in new projects. Regulatory and fiscal measures will be fine-tuned to support the plan. Jal Jeevan Mission. Since 2019, 15 crore households representing 80% of India's rural population have been provided access to portable tap water connections. To achieve 100% coverage, I am pleased to announce the extension of this mission until 2028 with an enhanced total outlay. The mission's focus will be on the quality of infrastructure and O&M of rural piped water supply schemes through Jan Bhagidari. A separate MOU or separate MOUs will be signed with the states and union territories to ensure sustainability and citizen-centric water services delivery. Urban sector reforms. Building on the July budget proposals, urban sector reforms related to governance, municipal services, urban land and planning will be incentivized. Urban Challenge Fund. The government will set up an urban challenge fund of 1 lakh crore rupees to implement the proposals for cities as growth hubs, creative redevelopment of cities, and for water and sanitation purposes announced in the July budget. This fund will finance up to 25% of the cost of bankable projects, with a stipulation that at least 50% of the cost is funded from bonds, bank loans, and PPPs. An allocation of 10,000 crore is proposed in 2025-26. Power sector reforms. We will incentivize electricity distribution reforms and augmentation of intra-state transmission capacity by states. This will improve financial health and capacity of electricity companies. Additional borrowing of 0.5% of GSDP will be allowed to states contingent on these reforms. Nuclear energy mission for Viksit Bharat. Development of at least 100 gigawatt of nuclear energy by 2047 is essential for our energy transition efforts. For an active partnership with the private sector towards this goal, amendments to the Atomic Energy Act and the Civil Liability for Nuclear Damage Act will be taken up. A nuclear energy mission for research and development of small modular reactors with an outlay of 20,000 crore will be set up. At least 5 indigenously developed small modular reactors will be operationalized by 2033. Shipbuilding. The shipbuilding financial assistance policy will be revamped to address cost disadvantages. This will also include credit notes for shipbreaking in Indian yards to promote the circular economy. Large ships above a specified size will be included in the infrastructure harmonized master list. Shipbuilding clusters will be facilitated to increase the range, categories, and capacity of ships. This will include additional infrastructure, facilities, skilling, and technology to develop the entire ecosystem. Maritime Development Fund. For long-term financing for the maritime industry, a Maritime Development Fund with a corpus of 25,000 crore rupees will be set up. This will be for distributed support and promoting competition. This will have up to 49% contribution by the government, and the balance will be mobilized from ports and from private sector. UDAN regional connectivity schemes. UDAN has enabled 1.5 crore middle-class people to meet their aspirations for speedier travel. The scheme has connected 88 ports, airports, and operationalized 619 routes. Inspired by that success, a modified UDAN scheme will be launched to enhance regional connectivity to 120 new destinations and carry 4 crore passengers in the next 10 years. 4 crore additional passengers in the next 10 years. The scheme will also support helipads and smaller airports in hilly, aspirational, and northeast regional districts. Greenfield airports will be facilitated in Bihar to meet the future needs of the state. These will be in addition to the expansion of the capacity of Patna Airport and a brownfield airport in Beta. Western Kosi Canal project in Mithilanchal. Financial support will be provided for the Western Kosi Canal ERM project, benefiting a large number of farmers, cultivating over 50,000 hectares of land in the Mithilanchal region of Bihar. Mining sector reforms. Mining sector reforms, including those for minor minerals, will be encouraged through sharing of best practices and institutions of a state mining index. A policy for recovery of critical minerals from tailings will be brought out. Under the special window for affordable and mid-income housing, SWAMI, 50,000 dwelling units in stressed housing projects have been completed and keys handed over to home buyers. Another 40,000 units will be completed in 2025, further helping middle-class families who are paying EMIs on loans taken for apartments while also paying rent for their current dwellings. Building on this success, SWAMI Fund 2 will be established as a blended finance facility with contribution from the government, banks, and private investors. This fund of 15,000 crore rupees will aim for expeditious completion of another 1 lakh units. PM Gati Shakti data for private sector. For furthering PPPs and assisting the private sector in project planning, access to relevant data and maps from the PM Gati Shakti portal will be provided. Tourism for employment-led growth. Top 50 tourist destination sites in the country will be developed in partnership with states through a challenge mode. Land for building key infrastructure will have to be provided by the states. Hotels in these destinations will be included in the infrastructure harmonized list. The following measures will be taken for facilitating employment-led growth. Organizing intensive skill development programs for our youth, including in institutes of hospitality management. Providing mudra loans for homestays. Improving ease of travel and connectivity to tourist destinations. Providing performance-linked incentives to states for effective destination management, including tourist amenities, cleanliness, and marketing efforts. And introducing streamlined e-visa facilities along with visa fee waivers for certain tourist groups. Continuing with the emphasis on places of spiritual and religious significance, in the July budget, there will be a special focus on destinations related to the life and times of Lord Buddha. Medical tourism and heal in India. Medical tourism and heal in India will be promoted in partnership with the private sector, along with capacity building and easier visa norms. Investing in innovation. To implement private sector-driven research, development, and innovation initiatives announced in the July budget, I am now allocating 20,000 crore rupees for this purpose. A deep tech fund of funds will also be explored to catalyze the next generation startups as a part of this initiative. In the next 5 years, under the PM Research Fellowship Scheme, we will provide 10,000 fellowships for technological research in IITs and IISc with enhanced financial support. The second gene bank with 10 lakh germplasm lines will be set up for future food and nutritional security. This will provide conservation support to both public and private sectors for genetic resources. We will start a national geospatial mission to develop foundational geospatial infrastructure and data. Using PM Gati Shakti, this mission will facilitate modernization of land records, urban planning, and design of infrastructure projects. A Gyan Bharatam mission for survey, documentation, and conservation of our manuscript heritage with academic institutions, museums, libraries, and private collectors will be undertaken to cover more than 1 crore manuscripts. We will set up a national digital repository of Indian knowledge systems for knowledge sharing. Now I move to exports as the fourth engine. We will set up an export promotion mission with sectoral and ministerial targets driven jointly by the Ministries of Commerce, MSME, and Finance. It will facilitate easy access to export credit, cross-border factoring support, support to MSMEs to tackle non-tariff measures in overseas markets. A digital public infrastructure, Bharat Trade Net, for international trade will be set up as a unified platform for trade documentation and financing solutions. This will complement the Unified Logistics Interface platform. The BTN will be aligned with international practices. Support will be provided to develop domestic manufacturing capacities for our economy's integration with global supply chains. Sectors will be identified based on objective criteria. Facilitation groups with participation of senior officers and industry representatives will be formed for select products and supply chains. Through this, there are huge opportunities related to Industry 4.0, which needs high skills and talent. Our youth have both. Our government will support the domestic electronic equipment industry to leverage this opportunity for the benefit of our youth. A national framework will be formulated as guidance to states for promoting global capability centers in emerging Tier 2 cities. This will suggest measures for enhancing availability of talent and infrastructure, building bylaw reforms, and mechanisms for collaboration